Have you ever felt like the world of finance and investing is this massive, impenetrable fortress?
Mm.
Like it's guarded by Wall Street pros with secret handshakes and complex algorithms, and there's just no way an individual investor can possibly compete.
Yeah,
If that resonates with you, then you are definitely not alone.
it's a sentiment we hear often. But here on the deep dive, our mission today is to, cut through that jargon, peel back the layers of complexity,
Right.
and genuinely show you how to navigate the markets successfully. We're going to take a deep dive into the foundational theories of stock valuation,
Okay.
explore some truly wild historical market crazes, scrutinize popular investment strategies, and finally reveal some very practical advice for every investor.
You might even find yourself outperforming some of those experts.
That's the hope.
That's our goal for you. Our guide for this deep dive is a truly insightful and absolute classic text on investment. We're talking about wisdom that can give you a real leg up in understanding how markets actually work.
Yeah, solid stuff.
So let's unpack this.
Okay, so to start, we really need to understand two core philosophies of investment.
Right.
The first is what's known as the firm foundation theory.
Firm foundation, okay.
At its heart, this idea suggests that a stock possesses an intrinsic value, a true worth, which is fundamentally based on the future stream of earnings a company can generate and distribute primarily as dividends.
So future profits paid out.
Exactly. The logic follows: the greater the present dividends and the higher their expected rate of increase, the higher that stock's fundamental value should be.
And a pioneer named John B. Williams even formalized this with a specific formula. Can you break down how he envisioned that intrinsic value could actually be calculated, perhaps with an example?
Absolutely. Williams introduced the concept of discounting future income.
Discounting.
Yeah, think of it this way. A dollar you expect to receive next year isn't worth a full dollar to you today.
Right, because you could invest it now.
Precisely. If you could earn, say, 5% interest on your money, then next year's dollar is only worth about 95 cents in today's value. He applied this to all those future dividends.
Okay, makes sense.
Then Graham and Dodd's seminal work, Security Analysis, widely popularized this approach.
The famous book.
The famous book. It converted a whole generation of Wall Street analysts to the idea of buying stocks when they traded below this calculated intrinsic value and selling them when they rose above it.
That sounds incredibly logical. I mean, I can see why it gained a famous disciple in Warren Buffett, often called the Sage of Omaha,
Yeah, the classic example.
who was legendary for his success supposedly by following this method. But what's the catch? It seems almost too straightforward.
You've hit on the slippery little factor, as our source puts it.
Slippery factor, okay.
While seemingly sound, this theory heavily relies on tricky forecasts of future growth, both its extent and, crucially, its duration. How long will it last?
Right. Predicting the future. Always easy.
Exactly. And when market enthusiasm is running high, companies might be discounting not only the future, but perhaps even the hereafter.
The hereafter.
Meaning their foundation becomes far less dependable because it's built on such optimistic and, uncertain predictions.
So if the firm foundation theory sounds solid but hinges on predicting the unpredictable, what happens when investors decide to just throw intrinsic value out the window and follow the crowd?
Well, that brings us to a completely different philosophy, doesn't it?
It does.
Precisely. That's the castles in the air theory.
Castles in the air. Sounds less stable.
It is. This approach completely shifts focus from internal value to external perception. It's all about investor psychology, market fads, and simply anticipating what other investors will be willing to pay for a stock rather than trying to figure out any inherent worth.
So it's not what it's worth, but what someone else thinks it's worth.
Or what you think they'll think it's worth.
Right.
It's about collective perception and building an investment on the hope that someone else will pay more for it than you did.
And if you want to see investor psychology in action, I mean, history is absolutely brimming with vivid examples.
Oh, definitely.
The Dutch tulip mania from 1634 to 1637 is perhaps the most famous and certainly one of the wildest.
Oh, it truly was. I mean, people were bartering land, jewels, even furniture.
For flowers.
For tulip bulbs, yeah, which reached astronomical levels in price.
Incredible.
What's particularly fascinating is how sophisticated the speculation became. They were even using what we'd recognize today as call options to maximize their speculative opportunities.
Wow. Even back then. It's astonishing how these patterns repeat, isn't it?
It really is.
While some revisionist historians, like Peter Garber, have argued that maybe some rationality existed, pointing out that rare bulbs were highly valued even before the mania.
Right, there was some underlying value.
But he still couldn't explain that 20-fold increase in tulip bulb prices during January of 1637, followed by an even larger decline in prices in February.
Yeah, that exponential blow-off and collapse, it defied any rational explanation of intrinsic value.
So what happens when the collective belief system just breaks down?
Well, when people decided to sell, it was exactly like a snowball rolling downhill.
Oh.
Panic led to rapid bulb deflation. The collective belief that these bulbs would endlessly increase in value simply vanished, and the castle in the air collapsed spectacularly.
And did we see similar patterns unfold in other periods of history, perhaps with different assets?
Absolutely. Fast forward to the 18th century, and you have the infamous South Sea Bubble.
Ah, yes. Another classic.
The South Sea Company was granted a monopoly over trade to the South Seas as a reward for assuming nearly 10 million tons of government debt.
Okay, a government deal.
Right. But the directors, with their insider knowledge, quietly bought government securities low and then exchanged them for South Sea stock at par.
Making a quick buck.
Making quick, early profits. And the kicker, not a single director had the slightest experience in South American trade.
Seriously, none.
None. Their profits were based entirely on hype, not actual business acumen.
So it was pure speculation built on a paper promise. And when the truth inevitably leaked that the company's actual prospects had no relation to its wildly inflated value, what happened?
The stock price collapsed, of course. Wiped out fortunes. It's a classic example of how far market madness can go.
Wow.
Even Isaac Newton, one of the greatest scientific minds in history, famously remarked, "I can calculate the motions of heavenly bodies, but not the madness of people."
After losing big himself, right?
They were losing a substantial amount, yeah. Even the most brilliant minds aren't immune to the allure of a rising market.
We fast forward again, 1929 stock market crash.
Yeah.
This wasn't just about big institutional players. Individual greed and irrationality were rampant. Can you tell us about Albert Wiggin, for example?
Albert Wiggin, yeah, the head of Chase Bank. He exemplifies this perfectly. He sold short more than 42,000 shares of Chase stock.
His own bank stock.
His own bank stock, because he believed prospects for it were dim.
Okay, maybe remind us quickly what selling short means.
Sure. Selling short means you borrow shares and immediately sell them on the market, hoping the price will drop.
Right.
You then buy them back at that lower price, return the borrowed shares to the lender, and pocket the difference. It's basically betting on a decline.
So he was betting against his own company.
Oh, running it, yeah.
And even after the initial decline, renowned economist Irving Fisher seemed to be living in his own castle in the air.
Oh, absolutely. He dismissed it as a shaking out of the lunatic fringe.
Just a blip.
Yeah, bizarrely, even linking market value to the beneficent effects of prohibition. He believed prices hadn't caught up to real value.
Wow. Talk about optimistic.
It shows how deeply ingrained the belief in perpetual growth can be. Now, while some revisionist historians, like Harold Bierman Jr., argue stocks weren't obviously overpriced without perfect foresight.
Hindsight is 20/20.
Exactly, and they suggest the Federal Reserve's policy of raising interest rates to punish speculators precipitated the crash. The enduring lesson is still clear. Very sharp increases in stock prices are seldom followed by a gradual return to relative price stability.
The crash is often as swift as the ascent.
Usually swifter.
It sounds like a recurring theme across these bubbles is the triumph of story over substance. Is that fair to say?
That's a profound observation. It absolutely is. And these crazes didn't stop in the early 20th century.
Oh, no. We saw them continue throughout history. For instance, the 1960s brought us the conglomerate craze.
Yes. Companies like Synergon Inc. appeared to increase earnings per share simply by merging non-growing companies.
How did that work?
Well, through accounting magic, basically. It was this manufactured growth that truly dazzled unwary investors.
Okay.
They even used what was termed creative accounting, deferring new product development and startup costs, or even retroactively selling off divisions to hide subsidiary losses.
Wow. Hiding the bad stuff.
And the managers of these conglomerates really invented a new language to sound technologically advanced. They'd throw around phrases like market matrices and core technology fulcrums.
Buzzwords.
Total buzzwords to impress. But investors eventually became disenchanted when they realized that, 2 plus 2 certainly did not equal 5.
Right.
leading to a significant reduction in those premium multiples they once enjoyed. It was all a facade.
We saw it again with the Nifty 50 in the 1970s.
Yeah, those premier growth
It
stocks.
became wildly overpriced and then eventually fell completely from favor. And the biotech mania in the 1980s was another classic case.
Oh, that was a spectacular example. Stocks would sell at 50 times sales for companies with no current earnings and little sales.
50 times sales, not earnings.
Sales, because there were no earnings. Analysts even concocted a new valuation method called product asset valuation, estimating value based on products in the pipeline, even if it was, and I quote, nothing more than the drawings of a genetic engineer.
Just an idea on paper.
Pretty much. The story was enough for many to ignore the lack of actual product.
And then there was Glycol in 1985. Alphen Fragrances touted this miracle anti-aging cream,
Yes, the miracle cream.
boosted by an endorsement from Christian Barnard, the heart transplant pioneer.
Huge name recognition.
The stock tripled within a month, and even established firms like Morgan Stanley justified its stratospheric price-earnings multiple.
It's incredible what an endorsement can do, even when the fundamentals are shaky.
Then came ZZZZ Best in 1987.
Which turned out to be just a giant Ponzi scheme.
Oh, wow.
That was also laundering money for the mob. Its spectacular growth was entirely fictitious, a complete house of cards.
And who could forget the Japanese bubble in the late 1980s?
That was huge, fueled by the widespread belief that Japan was different.
The different this time argument.
Always dangerous. And that its Ministry of Finance would somehow prevent a fall. Investors ignored history and economic fundamentals.
What were they doing?
Speculators used shares as collateral to buy property, which then collateralized buying more shares. It was this truly wild feedback loop.
Until it wasn't.
Until it ended in decades of stagnation.
And finally, the internet bubble of the late 1990s.
Yes. Companies like Broadcast.com, formerly Audionet,
I remember them.
which was losing money hand over fist, was valued at $1 billion in a matter of minutes after its IPO. Shares soared from $18 to $74 on opening day.
Just unbelievable valuations.
These historical lessons consistently show us that when the castles in the air get too high, they inevitably come crashing down. The constant is human behavior, psychology.
So with all these historical lessons about speculative crazes and the undeniable power of collective psychology, let's turn our attention to how people actually try to make sense of the market.
Okay.
We have two main traditional approaches: technical analysis and fundamental analysis. Let's start with technical analysis, often called chartism.
Right. Chartists are essentially studying the price movements of stocks, looking for patterns and trends. They often refer to this as the wallpaper principle.
Wallpaper principle.
Yeah, the idea that patterns repeat. They believe momentum exists and that they can somehow pick up the scent of the smart money.
Following the trend.
Exactly. However, academic economists have extensively shown that stock prices behave very much like a random walk.
A random walk, meaning...
Meaning patterns occur no more frequently than, say, runs of luck in the fortunes of any gambler. It's like looking at clouds and seeing faces. They're there, but not for any predictive reason.
So if I'm trying to filter through the noise and figure out if these patterns actually work, have there been practical tests of these filter rules, like, say, selling if a stock falls 5%?
Yes, lots of tests. And exhaustive testing shows they cannot consistently beat a policy of simply buying and holding it, especially once you factor in transaction costs.
So the trading costs eat up any potential gains.
Often, yes. Our source even shares an anecdote about a broke technician who blamed his failures on not believing his own charts.
Ah, classic.
And the expert in the source even have a tongue-in-cheek rule never to eat with a chartist.
Okay, so despite this overwhelming evidence, chartists still find excellent employment opportunities, and charting software is booming. Why do you think that is?
Well, I think it largely comes down to the enduring allure of an easy way to get rich quick.
The siren song.
Exactly. People want to believe there's a secret, a pattern they can crack, rather than accepting the market's inherent unpredictability.
So if chasing momentum through charts proves to be, well, a random walk, what about the more rigorous data-driven approach, what we call fundamental analysis?
Right. The other main school.
Does that fare any better? The ideal picture is a statistician meticulously recording financial data, then becoming a security analyst, making field trips, eventually earning the Chartered Financial Analyst designation. This sounds much more grounded.
It certainly seems more grounded, and the ideal is indeed that of a meticulous, data-driven professional. However,
Uh-oh, there's a however.
The academic critique isn't kind here either. It finds that calculations of past earnings growth are no help in predicting future growth.
Past performance is no guarantee.
Not even a good according to this research. There was a study charmingly titled Higgledy-Piggledy Growth,
Hey, great name.
which found that knowing the fastest growing companies from 1980-90 offered basically no insight into which companies would be fast growers from 1990-2000.
So it's essentially random again.
It seems largely random over those longer periods. Furthermore, professional forecasts of long-run earnings growth were often less accurate than a naive forecasting model, like just assuming average national income growth.
Wow. Less accurate than just guessing the average.
Often, yes. Now, short-term one-year predictions are a bit more reliable, but longer-term forecasts are notoriously difficult.
And I remember reading something in the source about creative accounting that can really muddy the waters, even for the most meticulous analysts.
Oh, absolutely.
There was a great quote about an income statement resembling a bikini.
Yes. The source famously says, a firm's income statement may be likened to a bikini. What it reveals is interesting, but what it conceals is vital.
Ah, love that.
Companies can use practices like deferred new product development and startup costs or unamortized costs of prepaid sales programs to make their financials look better than they really are.
Some moving things out.
Or worse, national student marketing was notorious for this. Or, consider the SDP example, a company aggressively touting its oil additive, while a reputable publication like Consumer Reports deemed it a worthless oil thickener.
So the numbers can lie, or at least mislead.
The numbers can be manipulated to tell a story that isn't quite true. Absolutely.
And when you look at actual mutual fund performance, the evidence suggests no good deal of consistency. We often hear about hot hands, right? Managers who seem to consistently outperform.
Yeah, the star managers.
Is that phenomenon real?
Well, the research suggests it's often attributable to chance, like a run of heads when flipping a coin. If you have enough fund managers out there, some will inevitably have a good run by pure luck.
Right. Law of large numbers.
Exactly. The only element of predictability consistently found is that mutual funds with abnormally high expense ratios tend to be below average performers.
Cost fees.
This is a critical takeaway. High fees do not buy better investment management. Quite the opposite. You're just paying more for the same or often worse performance.
So if traditional analysis isn't consistently beating the market, and high fees hurt, what does modern investment science tell us about managing our money?
Okay, this is where things get interesting with modern theory.
This is where modern portfolio theory, or MPT, comes in. What's its core premise?
MPT's core premise is straightforward. Investors are generally risk-averse.
Meaning
They want the highest possible returns for the least amount of risk they have to take. Makes sense, right?
Yeah, sounds reasonable.
So, to quantify risk, MPT uses measures like variance and standard deviation. Think of standard deviation as a gauge of how much an investment's returns tend to swing around its average.
Like how bumpy the ride is.
Exactly. A higher standard deviation means you're more likely to take a real bath in the market, experiencing significant ups and downs, more volatility.
So it's essentially measuring the choppiness of the ride. And the theory highlights the power of diversification. What kind of risk can diversification actually eliminate?
Right, the choppiness. Diversification is incredibly powerful because it distinguishes between two types of risk, unsystematic and systematic.
Okay, two types. Unsystematic.
Unsystematic risk is company-specific variability, things like a new contract falls through, a product recall, maybe even corporate fraud, stuff unique to that one company.
Got it.
The good news here is that this can be significantly reduced, if not entirely eliminated, by diversification, by owning lots of different stocks. Well, the research suggests a portfolio of around 20 carefully chosen unrelated securities can essentially wipe out most of that company-specific unsystematic risk.
Okay, 20 is manageable. But then there's systematic risk or market risk.
Ah, yes, the big one.
This is the variability that results from all stocks moving more or less in tandem with the overall economy and market sentiment. You can't diversify this away, can you?
No, you cannot. Even a perfectly diversified S&P 500 index fund still fluctuates with the overall market. You can't avoid economy-wide events.
Right.
The Capital Asset Pricing Model, or CAPM, ties this together. It basically says as systematic risk increases, so does the expected return investors demand for holding it.
And that systematic risk is measured by something called beta, right?
Correct, beta.
So if I'm understanding beta, it's essentially a stock's market sensitivity score. If the market moves 1%, a stock with a beta of 2 tends to move 2%, for better or worse.
That's a perfect analogy. Beta is your market sensitivity. Higher beta means potentially higher returns, but also a bumpier ride, more volatility tied to the market.
Right. But some feel beta isn't the whole story, that it fails to capture a number of important systematic elements of risk.
Exactly. That's where arbitrage pricing theory, or APT, comes in.
APT, okay.
APT suggests that the only risk investors should be compensated for bearing is the risk that cannot be diversified away. Systematic risk.
Makes sense.
But it proposes that there are several other systematic risk measures beyond just beta that also affect valuation and expected returns.
So APT is essentially saying that beyond just how much a stock moves with the overall market, there are other inherent qualities of a company,
Right.
like its size or how it's valued compared to its earnings or assets, that independently affect its expected return. Can you give us a quick example?
You've nailed it. APT suggests factors like size. Smaller firms tend to have higher rates of return, perhaps because they are perceived as riskier or are less followed by large institutions.
Okay, the small cap premium idea.
Exactly. Also, firms with low PEs, price earnings multiples, tend to produce higher returns, the value premium, as do those with low price book value ratios.
More value factors.
These are considered additional systematic risks or factors that, if you take them on, the market seems to compensate you for over time.
Interesting. So multiple dimensions of risk. And what about investing beyond your home borders? Historically, has international diversification actually been a benefit?
Oh, it has been a significant benefit historically. Our source shows that a mix of U.S. and developed foreign stocks, say roughly 24% foreign and 76% U.S. between 1977 and 1997, actually offered higher returns,
High returns.
with less risk than an all-U.S. portfolio.
Oh, wow. Higher return, lower risk. The holy grail. Why?
Because international diversification helps reduce risk because economic cycles aren't perfectly correlated across countries. When one economy is down, another might be up, smoothing out your ride.
There's a debate, of course, with some arguing that globalization of the world economies has blunted the benefits,
Yeah, you hear that a lot.
citing events like the 1987 crash or the Asian contagion spreading globally. Seems like markets move together more now.
Well, while those events certainly show interconnectedness, especially during crises, careful research does not reveal a long-term trend toward increased correlation among world markets.
Really? Still beneficial then?
The diversification benefits still seem to be there for those who look closely and invest internationally for the long term, yes. The correlations aren't perfect.
Okay. All of this leads us to the concept of market efficiency itself, the random walk or efficient market theory.
The big one, EMH.
It states that future stock prices are difficult, if not impossible, to predict. Can you quickly walk us through the different forms of this theory?
Certainly, it generally comes in three flavors.
Okay.
The weak form says that past prices and trading volumes don't help you predict future prices. Looking at charts is useless for prediction.
So technical analysis is out, according to weak form.
Pretty much. Then the semi-strong form goes further. It states that even all publicly available information like company announcements, news articles, economic data is already priced into the stock.
So reading the news won't give you an edge either.
Not consistently, no. The market reacts too fast. And the strong form is the most extreme. It claims that even private, unpublished insider information can't help you consistently beat the market.
Wow. Even insider info, that seems counterintuitive.
It's a very strong claim and likely the least true in practice, but it sets the theoretical benchmark.
So if I'm understanding this, the weak form means charts are useless. The semi-strong form says reading the news won't give an edge, and strong form suggests even insiders can't consistently win.
That's a perfect summary. But the crucial clarification is that the theory doesn't mean prices move erratically or randomly like a drunkard.
Right, not chaotic.
No. It means the market is so efficient that prices move so quickly when new information does arise that no one can consistently profit by acting on it after it's known.
It's about speed of adjustment.
Exactly. It's not that the market is irrational, it's that it's too rational and fast for anyone to consistently exploit profit opportunities based on older public information.
But wait, there are some apparent predictable patterns or anomalies that seem to challenge this idea of complete market efficiency.
Ah, yes. The anomalies.
One that always seems to pop up is the January effect.
Indeed. This anomaly refers to abnormally higher stock returns during the first few days of January.
Why January?
Theories range from tax loss selling in December depressing prices, to New Year optimism, to portfolio rebalancing, and it's particularly strong for smaller firms.
Which relates to another one, the small firm effect.
Exactly. Historically, portfolios of smaller stocks outperformed larger ones. For instance, from 1926 to 1997, smaller stocks returned about 12.5% annually compared to 11% for the S&P 500.
So smaller stocks delivered more return. But does that mean the market isn't efficient, or is there another explanation, like maybe they're just riskier?
That's the debate. There are caveats. Is it true inefficiency, or is it just a measure of risk inadequacies not captured by standard models like CAPM? Or maybe survivorship bias? In the data, we only see the small firms that survive.
Good point.
It's also worth noting that during the 1990s, there has been little to gain from holding smaller stocks, which shows these anomalies can also come and go. They aren't guaranteed.
We also see some interesting value investing predictors. It seems stocks with low PE multiples tend to outperform those with high multiples, which is considered a cardinal rule of stock selection for many.
Yes, the value premium again.
And stocks selling at low ratios of price to book value also tend to produce higher future returns. How do these fit into the efficient market idea?
These are fascinating and quite persistent. Interestingly, initial dividend yields and PE multiples can lead to a fair amount of predictability in the future 10-year rate of return based on long-term data like 1926, 1988.
So some predictability there.
Some, yes. But this can actually be consistent with efficient markets. For instance, higher dividend yields when interest rates are high are a logical outcome. Because investors demand more yield from stocks to compete with safer bonds when rates are high, it's a rational adjustment entirely consistent with efficient markets. The market is just pricing risk appropriately.
Okay, that makes sense. And then there's the dogs of the Dow strategy.
Ah, yes, very popular.
A contrarian approach where you buy the 10 highest yielding stocks in the Dow Jones Industrial Average at the start of the year.
Right. And this strategy historically outperformed the overall Dow index by maybe 2–3% annually without appearing to take on additional risk.
Is this another example of an anomaly?
Yeah.
Or is it capturing some value tilt?
It's often cited as an anomaly, possibly capturing a value effect or benefiting from mean reversion in beaten-down stocks. So the bottom line is,
Yes.
pricing irregularities and predictable patterns in stock returns may well exist and even persist for periods of time, and markets can be influenced by fads and fashions. We saw the bubbles. However, eventually, any excesses in market valuations will be corrected. Gravity takes hold. Ultimately, despite these fascinating exceptions and anomalies, the stock market is remarkably efficient. It's incredibly difficult to consistently beat it through active trading or stock picking.
Okay, given all this complexity, the historical bubbles, the debunking of traditional analysis, the nuances of market efficiency, how can you, the individual investor, actually navigate this complex world? What's the fundamental truth we need to remember?
The fundamental truth, reiterated throughout our source, is simply this. There is no sure and easy road to riches. Sorry, folks.
No magic bullet.
No magic bullet. High returns, as we've seen, can be achieved only through higher risk-taking or perhaps by accepting less liquidity investments you can't sell quickly. It's always a trade-off, not a secret.
So what's the single most important decision an investor can make then, if not picking the winning stock?
It's asset allocation.
Asset allocation.
Meaning how you divide your money between the major asset categories, stocks, bonds, real estate, cash, etc. This is critical because over 90% of an investor's total return is determined by this mix.
90%.
Over 90%, according to major studies. It's not about picking individual stocks nearly as much as it is about getting the big picture right for your situation and risk tolerance.
That's a powerful insight. Okay, let's get into some key practical advice for our listeners then. First, there's a strategy called dollar cost averaging. How does that work, and why is it beneficial?
Dollar cost averaging is simple but effective. It means investing the same fixed amount of money at regular intervals, say every month, regardless of what the market is doing.
So automate it.
Pretty much. This reduces risk because it ensures you automatically buy fewer shares when prices are high and more shares when prices are low.
It takes the emotion out of timing the market.
Exactly. It takes emotion and guesswork out of the equation and imposes a disciplined approach. Very useful for long-term investing.
And in terms of building wealth, what role do tax advantage savings play? Things like retirement accounts.
Oh, they are incredibly important. You should absolutely utilize employer 401k or 403b plans if they're available.
Especially if there's a match.
Definitely grab the employer match. That's essentially free money. IRAs also allow tax-deferred compounding of earnings.
How much difference does that make?
A huge difference over time. For example, the source mentions a $2,000 annual contribution for 25 years can lead to a nearly $77,000 advantage over taxable investments just due to the power of compounding without that immediate tax drag each year.
77 grand just from tax deferral. Wow.
Yeah. And if you're far from retirement and maybe in a lower tax bracket now than you expect to be later, you should investigate Roth IRAs. With a Roth, you pay taxes upfront on contributions, but then withdrawals in retirement are completely tax-free.
Tax-free growth and withdrawals.
Nice. Very nice. Tax-deferred annuities can also be useful if you've maxed out other savings limits, providing tax-deferred interest accumulation, though they can have higher fees.
Okay. And what about protecting against that silent wealth eroder, inflation? What does our source recommend?
It suggests considering inflation-protected securities, or TIPS, Treasury Inflation-Protected Securities.
Yes. Okay.
These are designed basically as a lead shield against inflation. They guarantee your real purchasing power and offer a guaranteed real rate of return above inflation.
How do they work?
They adjust their principal value based on the consumer price index, so your investment keeps pace with inflation. Plus, you get a small fixed interest rate on top.
So a safe haven against rising prices.
Pretty much, yeah, for part of your portfolio.
And then there's real estate, a classic investment. What's the advice here?
Well, first, own your own home if you can possibly afford it.
The American dream.
A common rule of thumb is spending around 30% of your income on mortgage payments, taxes, and insurance. It acts as a forced savings mechanism and often provides a hedge against inflation over the long run.
What about mortgages, ARMs?
Adjustable rate mortgages, or ARMs, can offer lower initial interest rates, which can help affordability. But you need to be aware of the caps, how much the interest rate can change over time.
Right, protect against huge jumps.
And also watch out for the potential for negative amortization, where if rates rise sharply, your payment might not cover all the interest, and the unpaid interest gets added back to your loan balance. Your debt actually grows.
Yikes. Need to understand those terms.
Absolutely. Also, real estate investment trusts, or REITs, deserve a position in a well-diversified portfolio. They give you exposure to commercial real estate.
Like owning malls or office buildings indirectly.
Exactly. But remember our bubble lessons. REITs, like other common stocks, can become inflated during market crazes. Don't overpay.
Okay. On the flip side, some investments are better avoided if your main goal is appreciation. What are those?
Gold, for instance, is considered a sterile investment by our source.
Sterile.
Meaning it yields no income, no dividends, and actually has storage and insurance costs. It was seen as extraordinarily risky back at its 1980s peak prices.
But some people hold it for safety.
It can sometimes reduce risks because it often moves counter to U.S. market trends during times of uncertainty or high inflation. But as a core growth asset, probably not.
Okay. What about collectibles? Art, stamps, baseball cards?
For collectibles, the advice is clear. Buy those things because you love them, not because you expect them to appreciate in value.
Don't treat your hobby like an investment strategy.
Exactly. They often have very high commissions when you buy or sell, liquidity can be poor, and generally they've produced poor inflation-adjusted returns compared to financial assets.
Good to know. For those looking to manage their own trades, maybe buying index funds or individual stocks, what should they consider when choosing a broker?
Well, if you know exactly what you want to buy and don't need advice, definitely consider discount brokers. They can save you as much as 90% off the standard commission rates compared to full-service brokers who offer research and advice. You're just paying for execution.
Makes sense if you're doing your own homework.
Right.
Now let's talk about the Life Cycle Investment Guide, which tailors advice based on your age and stage of life.
Yeah.
It seems really practical.
Very practical, because your needs and risk tolerance change over time.
So if you're in your 20s, what kind of portfolio is recommended?
For someone in their 20s, a very aggressive investment portfolio is generally recommended.
Aggressive. Why?
Because you have lots of time to ride out the peaks and valleys of the market, decades potentially. So your portfolio should be heavily weighted in common stocks, including potentially higher risk stocks such as smaller companies and growth stocks, and also a significant share of international stocks for diversification.
Maximize that long-term growth potential.
Exactly. Time is your biggest asset when you're young.
And how does that advice shift for someone later in life, like Mildred in our source, who needs substantial income and safety?
For Mildred, the advice shifts dramatically. She needs safe investments that can generate substantial income.
Income is key.
Income and capital preservation are key. So the focus moves towards bonds, high dividend stocks, maybe some REITs for income.
Less focus on growth.
Much less. The emphasis is not on risky growth stocks because she no longer has decades to recover from potential market downturns. Safety and reliable income become paramount.
Makes sense. And perhaps the most highly recommended strategy in the source for most investors is indexing, or passive investing.
Yes, this is a core recommendation.
Why is this strategy so favored given everything we've discussed about market efficiency and the difficulty of beating the market?
Well, it's highly recommended precisely because it's consistent with the idea of reasonably efficient markets. If it's really hard, maybe impossible, to consistently beat the market average.
And why not just own the market average?
Exactly. Own the haystack instead of looking for the needle. Indexing is also very tax-friendly.
How so?
Index funds tend to have low turnover, meaning they don't buy and sell stocks frequently. This allows investors to defer the realization of capital gains or avoid them completely if the shares are later bequeathed to heirs. Less tax drag year after year.
Low cost, tax efficient, matches the market. Seems compelling.
It is.
And while the S&P 500 index was once the main recommendation, the advice has evolved a bit. What's the preferred index now and why?
Yeah, the thinking has broadened. Now, a broader Wilshire 5000 stock index or a total stock market index is often favored.
Why broader?
Partly because the extraordinary performance of large capitalization domestic stocks, like those dominating the S&P 500 in recent decades, will not continue indefinitely. Things revert to the mean.
And you mentioned small stocks.
And historically, as we discussed, smaller stocks have tended to outperform larger ones over the very long run. A total market index captures those two.
Got it. Capture everything.
Also, consider specific tax-managed index funds, like the Vanguard tax-managed fund mentioned in the source. These funds actively try to minimize taxable capital gains distributions.
And that makes a real difference.
It really can in a taxable account over long periods. The example given showed a $10,000 investment over 20 years with tax deferral from a tax-managed fund accumulated over $5,300 more than a comparable, normally managed taxable fund, just from tax savings.
Wow. Taxes matter.
Taxes matter a lot.
Okay, when selecting mutual funds, maybe active ones if you go that route, we've already covered not chasing hot hands or relying solely on past performance. So it's the number one thing to look for instead.
Pay particular attention to the annual fees charged, the expense ratio.
Fees again?
Fees again. This is the single most consistent predictor of future relative performance. High fees lead to inferior investment performance. They are a direct, guaranteed drag on your returns year after year. Keep costs low.
It seems like you're saying that despite all of the theories and analysis, the market remains a bit of a mystery, a blend of logic and human nature. But you've actually put your money where your mouth is on this, haven't you? Based on the source's author.
Well, the author of our source has, yes. He shares a personal anecdote. He invested book royalties in closed-end funds selling at substantial discounts.
Closed-end funds. What's the discount mean?
These are funds that trade on an exchange, like stocks, and sometimes their market price falls below the actual value of the assets they hold they sell at a discount.
So buying $1 worth of assets for, say, 90 cents.
Exactly. And he notes the strategy significantly outperformed the market, though it required courage because you're often buying things that are out of favor, going against the crowd.
So it worked out.
It did for him.
Yeah.
It shows that while pricing irregularities may well exist, and persist for a time, eventually, the financial laws of gravity will eventually take hold. The market tends to correct those discounts over time.
Okay, so as we wrap up this deep dive, it sounds like market valuations are always a blend of logical and psychological factors.
Absolutely. Both play a role.
That intrinsic value we discussed earlier, the firm foundation, it isn't a fixed point. It's more like a fuzzy band, right?
A fuzzy band is a great way to put it. And prices can move sharply within and sometimes outside that band due to uncertainty, fear, greed, confusion, all the human stuff.
And critically, the unexpected frequently happens.
Always. Think of wars, recessions, pandemics, terrorist attacks, things you can't forecast.
Right.
Our source even quips that you suspect that even God Almighty does not know what the proper PE multiple is.
A dose of humility.
A necessary dose of humility. It's a humble acknowledgement of the market's inherent unpredictability.
Looking forward, the source suggests returns will likely be lower than the really high growth periods of the 1980s and 1990s. Why is that?
Well, part of those strong historical returns came from valuations, like price earnings multiples increasing significantly, PE ratios expanded.
So stocks got more expensive relative to earnings.
Exactly. And that expansion has left little margin of safety for future growth to come from that particular source again. Valuations are already relatively high compared to history.
So don't expect a repeat of those specific decades.
Probably wise not to bank on it, yeah.
But on a relative basis, are there any areas that looked potentially attractive, according to this source at the time?
Well, at the time of writing, small company growth stocks looked potentially attractive. They were near a historical low relative PE multiple compared to large stocks in the late 1990s.
So relatively cheap.
Relatively cheap, yes. And they have historically outperformed large stocks over very long periods, albeit with more volatility. So while there are no guarantees, they could be worth considering for the long-term aggressive part of a portfolio.
Interesting. Okay, so here's a final thought for you, our listener, to chew on. Our source says investing is a bit like lovemaking.
Huh. Where is this going?
Ultimately, it is really an art requiring a certain talent and the presence of a mysterious force called luck.
Art, talent, and luck. Sounds about right.
But, and this is the key takeaway, with the knowledge you've gained today from understanding these theories, the history, the practical advice, you can certainly limit your risks and avoid much of the pain.
Manage the downsides.
Manage the downsides, making the game, as our source says, all the more enjoyable. It's about being prepared, being patient, managing your behavior, and understanding the enduring human element in the market.
Well said. It's a journey, not a sprint.